Nvidia has found a new way to sell more AI chips, and this time the strategy does not begin inside a semiconductor lab. It begins on Wall Street. The company has partnered with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR to create financing platforms designed to mobilize more than $500 billion for AI infrastructure. Nvidia itself could backstop as much as $125 billion, or roughly 1/4 of the potential deals. Instead of simply waiting for customers to find enough money to buy its hardware, Nvidia is now helping build the financial system that can fund those purchases. That is a major change in the economics of the AI boom. Nvidia became one of the world's most valuable companies by selling scarce GPUs to customers desperate for computing power. But AI infrastructure has now become so expensive that chip performance is no longer the only bottleneck. Capital is becoming a bottleneck too. Data centers require chips, networking, cooling, buildings, land, electricity, and years of construction. Big tech companies alone are expected to spend more than $730 billion on AI infrastructure this year, while startups and specialized AI cloud companies are trying to compete with companies that generate tens of billions of dollars in cash every quarter. Nvidia's solution is surprisingly similar to what happened in other capital-intensive industries. A car company does not require every customer to pay cash for a vehicle. Aircraft manufacturers work with leasing companies. Property developers use mortgages and project finance. Nvidia now wants AI compute to become financeable in the same way. The basic idea is simple. An AI company may want several billion dollars of Nvidia systems but may not have several billion dollars sitting in its bank account. Instead, outside investors can provide the capital. The customer uses the computing infrastructure and generates revenue from it over time. That revenue helps repay the financing. Nvidia sells more hardware immediately, while institutional investors gain access to a new type of infrastructure investment. The company says the new platforms are intended to provide dedicated pools of capital at attractive rates for frontier AI laboratories, enterprises, governments, and AI cloud companies. That distinction matters. A traditional server used internally by a company can be difficult for an outside investor to value. An AI cluster rented by the hour is different. Its GPUs may continuously generate revenue from customers paying for compute. That makes the infrastructure look more like a power plant, toll road, aircraft fleet, or data center than ordinary corporate IT equipment. Reuters reported that Nvidia and its financial partners want to create longer duration investments linked to the usage of AI infrastructure. Goldman Sachs is already talking with insurers, money managers, and banks about participating, while private credit firms and asset managers could supply different layers of debt and equity. This is where the strategy becomes especially powerful for Nvidia. Suppose an AI cloud company wants to spend $10 billion building new computing capacity. Without financing, that company must raise equity, issue expensive debt, or slow its expansion. All three choices can limit how quickly it orders Nvidia hardware. But if Wall Street finances most of the project because the GPUs themselves and their future revenue can support the loan, Nvidia removes part of the constraint that was preventing the customer from buying. In other words, Nvidia is not only increasing the supply of GPUs, it is increasing the supply of money available to purchase GPUs. And there is a strong reason Nvidia wants to do this now. The largest technology companies can finance AI investments using enormous cash flows, but the next wave of demand increasingly comes from AI labs, neo-cloud companies, governments, and enterprises that do not all have Microsoft-sized balance sheets. If Nvidia wants AI infrastructure spending to keep expanding, it needs those customers to obtain capital somehow. The company is already becoming more involved in financing specific projects. Reuters reported this weekend that Nvidia is discussing an investment of as much as $3 billion in SB Energy, the SoftBank subsidiary developing a massive Ohio data center project for OpenAI. Separately, Nvidia revised the structure of support being discussed for that project, with an initial guarantee reportedly falling below $120 billion from an earlier figure of $250 billion. These figures remain subject to negotiations, but they show how far Nvidia has moved beyond the traditional role of a semiconductor supplier. A chip company normally designs a product, sells it, and lets customers worry about how to finance everything afterward. Nvidia is increasingly participating in almost every layer surrounding the sale, investing in AI companies, supporting data center developers, partnering with cloud operators, securing manufacturing capacity, and now helping institutional investors finance compute infrastructure. This creates a flywheel. More financing allows more AI infrastructure to be built. More infrastructure requires more Nvidia systems. A larger installed base makes Nvidia's CUDA software ecosystem even more important. A stronger ecosystem makes Nvidia hardware more attractive to the next customer. That customer can then use the same financing infrastructure to build even more capacity. There is also a second benefit that is easy to miss. By turning Nvidia Compute into an investable asset class, the company could reduce customers' cost of capital. If insurers and pension-linked investors eventually view AI infrastructure as predictable enough to finance at lower rates, projects that previously looked too expensive may suddenly become economically viable. Nvidia does not have to cut the price of its chips if it can help customers reduce the cost of financing them. But this strategy also creates a strange circularity. Nvidia sells GPUs to AI companies. Investors finance those AI companies so they can buy Nvidia GPUs. Nvidia may guarantee part of that financing. The customers then need to earn enough money from AI services to repay the investors. If demand for AI compute remains enormous, the system works. Nvidia gets hardware sales, customers get infrastructure, and lenders earn returns. If demand disappoints, the structure becomes much more complicated. This is the central risk behind Nvidia's $500 billion plan. AI chips are valuable today because computing capacity is scarce and demand is growing quickly, but GPUs are not permanent assets. New generations arrive rapidly. A Blackwell system that looks extremely valuable today could become less competitive when several newer architectures are available. If lenders finance projects assuming GPUs will maintain high utilization and resale value for years, technological obsolescence becomes a financial risk. Reuters Breaking Views compared the proposed financing structure with markets such as auto lending, where an underlying physical asset supports the loan. But cars depreciate relatively predictably. The value of AI hardware depends on software compatibility, energy efficiency, competition, utilization rates, and how quickly new chips improve. That makes Nvidia's dominance especially important to the model. If Nvidia systems remain the industry standard, the collateral is easier to value. If competitors suddenly take significant market share, the economics could change. There is another risk. Customers might be building infrastructure faster than AI businesses can monetize it. The current assumption is that demand for inference, AI agents, enterprise software, robotics, sovereign AI, and new model training will absorb enormous amounts of computing capacity. But infrastructure investments are being made years before anyone knows exactly how large those revenue streams will become. That is why the financing model is strategically useful to Nvidia but potentially dangerous for the broader market. Financing allows spending to continue even when customers could not afford the same build-out using only their own cash. That can accelerate a productive technology revolution, but it can also allow capacity to grow ahead of economically sustainable demand. The comparison with telecommunications infrastructure is instructive. During previous investment booms, companies borrowed heavily to build networks because everyone agreed that internet traffic would grow. They were correct about the technology trend, but some investors still lost enormous amounts of money because too much infrastructure was constructed too quickly. A technology can change the world while individual projects still produce poor financial returns. Nvidia appears aware of this issue. It is not promising to finance the entire $500 billion itself. The platforms are designed primarily to mobilize third-party capital, and the company has not disclosed specific commitments from each financial partner or a fixed timetable for deployment. The agreements currently establish the framework rather than guaranteeing that the full amount will immediately be invested. That distinction is crucial. The headline is $500 billion, but Nvidia is not writing a $500 billion check. Wall Street is being invited to treat AI compute as infrastructure and provide most of the capital. From Nvidia's perspective, that is much more attractive. If the company can use a limited amount of its own balance sheet to unlock several times more outside investment, every dollar of support could create multiple dollars of potential hardware demand. This may ultimately become one of Jensen Huang's most important strategic moves. Nvidia first won the AI boom by building the hardware. Then CUDA helped create a software ecosystem around that hardware. Now the company is trying to create a financial ecosystem around the entire stack. The next battle in AI may therefore be less about who can design the fastest chip, and more about who can finance the enormous physical infrastructure required to deploy those chips around the world. Nvidia has already solved one bottleneck, compute performance. It has spent years attacking another bottleneck, chip supply. Now it is targeting a third bottleneck, money. If the strategy works, Nvidia will no longer have to wait for customers to become rich enough to buy more GPUs. It can help Wall Street provide the capital, help customers build the data centers, and then sell the hardware that fills them. That is what makes the $500 billion financing plan so significant. Nvidia is not merely trying to capture more of the AI infrastructure market. It is helping create the market that will finance its own future growth.